Hi everyone, myself Murugan. Happy to present another interesting video from me. In this video, I'll be talking about the 4 important things that you need to know before you buy the dividend paying stocks. Because when you buy a dividend paying stocks, maybe 10 years or 15 years down the line, you must be expecting a recent cash flow which may be needed for your day-to-day expense. So you don't have to sell your capital asset. You can still hold on to it, but you still expect on top of it kind of consistent cash flows. So even in the previous video, we talked about the terminology, stock selection criteria, and various aspects relevant to dividend. But this is a video which is a follow-up video to the previous one, where we're gonna take two top companies equally good in terms of paying dividends. But how do I choose one from a very longer term perspective? So we're gonna see detail, and we will bring a very clear winner out of this particular top two company, TCS and Coal India. Both are known for dividend paying company, but which one I should buy? So let's get in this comparison. So this is specifically a comparison video comparing TCS versus Coal India on these 4 factors. The first one is, if you really want a dividend from a very longer term perspective, go and read the dividend distribution policy. Of course, we have to judge based on the dividend distribution policy. If the dividend distribution policy is predictability about the dividend, it gives you the predictability about the dividend, then it actually gives 1 point to that company, right? So we need to know the dividend distribution policy. The second one is the cash flows from operation should have a consistent growth so that the absolute growth in the dividend is expected. Some companies gives dividend 10 years before 6 rupees, now also 6 rupees, but this dividend growth is not there. So that can happen provided the business growth is there in the company, because we need to know that factor as well. The third factor is how much the company reusing that particular business in. If their capex is very high, then the money will not go out, am I right? So we need to find the business model where the capex or the business where the capex is low, and this is one more important factor. At last, the dividend payout ratio. Some companies makes profit, some companies doesn't have that much capex, but they keep accumulating the cashes. But we need to know that the payout policy is good or not. On these 4 factors, we're gonna judge two companies called TCS and Coal India. The very first factor is dividend distribution. If you look at the TCS dividend distribution policy, their policy is very clear that they're going to give 4 times in a year, and every 2 to 3 years, any surplus they accumulate in cash will be given in the name of special dividend. So it's very clear that almost every quarter you can expect something from TCS, which will make sure that you can meet out your expense. Because today the yield may be very low, but you buy shares today, and 10 years, 15 years down the line, from the current investment value, that particular may be a reasonable yield you will. Number one, you will be having a predictability in the TCS dividend distribution. And Coal India, no doubt, it is about the public sector enterprises, and it has a very long history of paying a consistent dividend. Although they don't have a specific clarity or the numbers with respect to dividend distribution policy, but one can really count on a public sector unit, especially the Coal India, which is a cash rich, and we can definitely have some serious expectations. So TCS and Coal India, on the dividend distribution policy, on the written notes, has got slight edge, but using their last 10-15 years behavior, both are reasonably good in this term. Second one is dividend payout ratio. Look at this dividend payout ratio. If you want to know where will I check it, that is why I told you that go and check out the previous video, because there we have given you how to go to Screener website where you can find the payout ratios and everything. So it's good that, because I don't want to revisit the same thing, which actually takes unnecessary time. But look at the dividend payout ratio. Okay, the TCS payout ratio is far consistent: 30%, 40%, 30%, 30%. In about every 3 years, you see some surges there, because any excess cash flow they got, they actually releases in every 3 to 4 years. So on that practice, they are very consistent about paying out their cashes to the shareholders. Look at the Coal India. They were 23%, 23%, 125%, 121%, 133%, 46%, 44%. They are also consistent about 30%. But the point is, they have a lot of variance. So the predictability goes slightly low because of the inconsistent behavior. Then in this factor, I say TCS got slightly better, but I don't see a very big improvement because both somehow managed to make the 30% consistent. So this can also be kind of neutral, slightly positive to these two factors. A very interesting factor is the cash flows from operation. Where companies pays dividend from, where they get money, only through business. So if the business growth rate is good, only then we can expect it. So the sales growth should be there. And cash flow from business operations, the cash flows from operations in TCS, if you look at it, 10 years before they were around 6,600 crores, and then it has become 7,000, 11,000, 14,000, 19,000, 19,000, 25,000. It has become 32,000, 38,000, 39,000. You see that the kind of consistent growth they managed to show about last 10 years, they managed to show that consistency very good. Whereas if you look at Coal India, they've shown 10,000, 8,000, 19,000, literally doubled in 2 years. Again, they got back to 14,000, 14,000, 13,000, and then they managed to make 21,000, again went back to 10,000. A lot of income. At the end of 10th year, you see not much of growth rate they managed to show on their cash flows from operation. Their growth rate is just zero, whereas the TCS growth rate is so. TCS business income is growing consistently, then probably we can expect some sort of returns. The dividend absolute amount may go up. So that clarity, that vision we can have with respect to TCS. So the TCS is actually having a clear edge on this particular factor, which is cash flows from operation. Because higher the better, and the TCS growth rate is way higher than the whole India. I hope you guys can easily see the difference. The last very interesting thing, let's say a TCS making a lot of money, right? Because we can see that uh, their business from operations are consistently growing. But are these money is used by company or this is getting distributed? So that can be seen with the capex. Capex is a capital expenditure that the company needs to keep that money. So if you look at the TCS, what you guys can see the last but one, that 2.68 lakh crore, all these numbers are actually in crores, okay? So 2.68 lakh crore in rupees is actually the total 10 years cash flows from business, okay? Cash flows from operations. So 2.68 lakh crore they made by doing business from operations, cash flows, and out of which they bought a kind of fixed asset in total 29,000 crores, maybe 1,800 crores, 2,000 crores. The kind of fixed assets they improved, the capital expenditure they made is only about 29 crores. So close to 11% of their business income is getting reused. Whereas if you look at Coal India, they made 1.5 lakh, 1.6 lakh crore approximately in last 10 years, out of which 66,000 crores got reused inside the business in form of plants and machineries and various fixed assets. So the point is, the Coal India need lot of money to be invested. Their capex is very high. Even in this on this ground, we can see TCS is a money making machine, and that machine doesn't need further money to make the further money. So in this case, whatever money they make may actually go back to the shareholders. So the cash shareholders will have lot better benefit investing in. So TCS is Coal India. Both are a very favorite stocks among people who wants to buy just for the sake of dividend. But we recommend TCS for these reasons. That both, if you look at it, now we are coming to the judgment area. TCS and Coal India, dividend distribution policy and dividend payout ratios are far clear. More or less, they are actually same. Needless to say, good or bad, both are equally good. Needless to compare it. But the last two factors, which is cash flows from operations and capex, are the clear differentiator on which the Coal India is actually lagging, and TCS managed to clearly win this verdict. So, if you are planning to invest from a longer term perspective, I know TCS and Coal India both are actually known for dividend paying stocks, out of which I think TCS is good because TCS not only paying dividend, and they also have a growth rate within the dividend, and so the share price can also have equal growth. In turn, it will add more wealth when compared to Coal India. But of course, if you want to diversify, Coal India can also be a part of your portfolio. Nothing wrong. But dividend paying stock on that grounds alone, TCS is a very clear winner. No doubt about it. So what next? Definitely we can ask a couple of questions in the comment section. If you find it interesting, put your questions. Or if you have any questions, kind of put a questions, how well we can answer it. And if you have any stocks in your mind, if you wish to make any comparisons, we recommend, why not, you can even take these factors and give us your opinion in the comment section, and we will also give you a feedback, so we can definitely work on it. And if you find this is good, the efforts what we have taken is actually good, kindly put a few words in the comments, so that it motivates and makes us to continue contribute such video. And wish to learn fundamental analysis, of course, by this video, I just make sure you are aware of one thing, that EQSIS also provide a training specifically on fundamental analysis for a very longer term investing. If you wish to invest, if you wish to build a portfolio from a longer term, you can definitely consider that particular training. The last one is, if you want EQSIS recommendation to build your portfolio longer term, we recommend this systematic investments in direct equity way better than giving away your money, because it saves a lot of cost. But you need to have some basic. So if you want a stock selection guidance review, what you can do is, you can actually go to equisis.com, our website, and there you see investing. You click on investing, you likely get to see the page. And in what this, it is a mere app, okay? And this app recommends a list of stocks on a consistent. Let's say if your choice of investing is week, then every week it will guide you what to buy. And if your investing mode is month, it will let you know every month what stocks. So this will remind you through Telegram. This may remind you with the email. And all you need to do is let us know how much. Let's say, and this app comes with just a very nominal fee, 999 for a year. So I believe it's far worth, and we got a very good feedback for this. And let's say if you wish to invest about, let's say, 30,000 rupees, and every month you wish to invest 30,000. So what stocks to buy every month? And we change the reviews, and accordingly it will reduce or increases the quantity. Accordingly, you will have a well balanced, diversified longer term. I'm sure this tool is also equally good for you. If you find this video till this minute very attractive, useful content, consider sharing this video and put a one like, so that it motivates.